Most people believe they understand how wealth works. They think it's about money moving faster, about spotting trends early, about buying what everyone else wants, just a little sooner. That belief feels comforting. It suggests the game is fair, that success is simply a matter of timing and effort. But what if that belief is precisely what keeps most people permanently late? Because while the public debates gold prices, argues about Bitcoin, and refreshes stock charts, something far more important is happening quietly, methodically, and almost invisibly. The world's most powerful investors are moving their money away from the assets everyone talks about, and into assets most people barely understand. Not because they expect spectacular returns next quarter, but because they are preparing for something deeper. A structural shift, a moment when the rules that governed wealth for decades begin to fail. Not dramatically, but functionally. And when that happens, the definition of value changes. Before we go any further, pause for a moment. Think about the last major crisis you lived through, the 2008 financial collapse, the pandemic, the inflation surge that followed. In every case, ask yourself a simple question. Who emerged stronger? It wasn't the people chasing trends. It wasn't the people who trusted headlines. It was those who owned things that remained essential regardless of chaos. This is not speculation. It is historical pattern. And patterns are the only reliable teachers in finance. Today, I want to walk you through 3 assets that billionaires are quietly accumulating. Not loudly, not publicly, and not for prestige. Assets that don't look exciting. Assets that rarely trend on social media. Assets that seem almost boring. And that is precisely why they matter. Because when systems become unstable, boring becomes priceless. Let's begin by dismantling the illusion most people still live inside. Turn on financial news any day of the week and you'll hear the same narrative. Gold is hitting new highs. Bitcoin is approaching another milestone. Real estate is recovering or collapsing, depending on the day. The story is always the same. The ultra-rich are supposedly buying exactly what the public sees, but this is surface theater. Because by the time an asset dominates headlines, serious capital has already repositioned. This is not cynicism, it's mechanics. Large wealth cannot move quickly or publicly without distorting markets. So it moves quietly, patiently, often years in advance. And history proves this repeatedly. In the early 1970s, before the US officially abandoned the gold standard, smart money began accumulating tangible assets, farmland, commodities, energy infrastructure, while the public debated currency policy. In the late 1990s, while retail investors chased dot-com stocks, institutional capital quietly rotated into hard assets and defensive holdings months before the crash. In the mid-2000s, sophisticated investors exited mortgage-backed securities while they were still being sold as safe. The pattern is always the same. The crowd reacts, the elite anticipates, and anticipation today looks nothing like gold bars or crypto wallets. It looks like control over essentials. The first asset we need to understand is farmland, not agricultural ETFs, not farming stocks. Actual land. At first glance, farmland seems outdated. It doesn't scale like technology. It doesn't promise exponential growth. It doesn't fit the modern obsession with speed. Yet historically, farmland has outperformed nearly every asset class over long periods. According to data from the U.S. Department of Agriculture and multiple academic studies, American farmland has delivered stable real returns for over a century, surviving depressions, wars, inflation cycles, and currency shifts. Why? Because farmland sits at the intersection of 3 immutable forces: food, water, population. You can digitize money. You can automate labor. You can financialize almost anything. But you cannot replace soil, you cannot manufacture rainfall, and you cannot feed populations with software. This is why farmland ownership has always clustered among the wealthy during periods of uncertainty. What's different today is the scale and the precision. Consider this. One of the largest private farmland owners in the United States is not a traditional agricultural family. It is Bill Gates. Through his private investment firm, he has accumulated hundreds of thousands of acres across multiple states. This is not ideological, it is strategic. And when you examine where this land is located, a pattern emerges. Not random farmland, not speculative acreage, but land with exceptional soil quality, access to reliable water, and long-term climate resilience. Historically, societies that lost control over food production lost sovereignty soon after. Rome learned this, so did countless empires that relied too heavily on trade routes rather than production capacity. In modern terms, owning farmland is not about farming profits. It is about optionality. The ability to produce when supply chains fracture, the ability to lease when prices surge, the ability to hold something real when currencies weaken. During the Great Depression, farmland values declined far less than equities. During the inflationary 1970s, farmland prices soared. During the 2008 crisis, farmland recovered faster than housing. This is not coincidence. It is function. But farmland alone is not enough, because land without water is just dirt. Which brings us to the second asset, and arguably the most misunderstood one. Water rights, not water utilities, not bottled water companies. The legal right to extract, control, and allocate water. In the western United States, water does not automatically belong to landowners. It belongs to whoever holds the legal claim. These claims were often established in the 19th century under a doctrine known as first in time, first in right. The implication is staggering. Someone who claimed water access 150 years ago may have absolute priority today, even over cities. As droughts intensify and aquifers deplete, these rights become exponentially more valuable. Historically, control over water has always translated into power. Ancient civilizations rose along rivers for a reason. In modern America, the battle is legal rather than military, but no less consequential. We are already seeing cities paying hundreds of millions of dollars for access rights that cannot be replicated. And this is why sophisticated capital has spent decades quietly consolidating them. Not for speculation, for inevitability. Water scarcity is not a theory. It is a mathematical certainty. Population growth plus climate volatility equals constraint. And in constrained systems, those who control access dictate terms. Now pause again. Notice the common thread. Farmland, water rights. These are not financial assets. They are civilizational assets. They function regardless of markets. They matter regardless of ideology. They retain value regardless of monetary policy. And they share one critical characteristic. They are boring until they are indispensable. Which brings us to the third asset. One so obscure that even many professionals misunderstand it. Yet one that institutional investors, pension funds, and billionaires have been accumulating aggressively. Catastrophe bonds. These instruments do something counterintuitive. They allow investors to earn high yields by assuming specific, measurable disaster risk. Hurricanes, earthquakes, floods. Not market risk, physical risk. Historically, markets crash together, stocks fall, bonds fall, real estate follows. But natural disasters are uncorrelated with financial cycles. A hurricane does not care about interest rates. An earthquake does not respond to central banks. This makes catastrophe bonds uniquely valuable. They are not designed for excitement. They are designed for resilience. When traditional portfolios fail to diversify, as seen repeatedly in the last decade, catastrophe-linked assets continue functioning. This is why pension funds allocate to them. Not because they are exciting, but because they are independent, and independence is the rarest form of security. Now step back and look at the full picture. Farmland secures food. Water rights secure life. Catastrophe bonds secure risk transfer. These are not growth plays. They are survival plays. They are not about beating the market. They are about existing when the market stops working the way people expect. Billionaires understand this, not because they are smarter, but because they think longer. They are not planning for next year. They are planning for the next system. And systems always change, not overnight, but inevitably. This is not fear. It is literacy. And if you stay with this analysis to the end, you will begin to see something unsettling and empowering. The real divide is not between rich and poor. It is between those who understand structure and those who chase narratives. In the next part, we will go deeper. We will examine why these assets are being accumulated right now, not 10 years ago, not 20, and what signals in history suggest we are approaching another transition point. To understand why these assets are being accumulated now, rather than a decade ago or a generation earlier, we need to step away from headlines and examine cycles, not market cycles, civilizational ones. Every era of concentrated wealth follows a familiar arc. First comes expansion, then complexity, then fragility disguised as sophistication. The late stage is always the most deceptive. From the outside, systems appear advanced, efficient, and resilient. From the inside, they rely increasingly on intervention, leverage, and confidence management. That is precisely where we are today. For most of modern American history, wealth accumulation followed a relatively simple logic. You produced value, you reinvested profits, you expanded cautiously. Land was productive, industry was tangible, capital formation was slow but grounded. Even during the industrial boom of the late 19th and early 20th centuries, wealth was anchored in physical output. Steel, railroads, energy, manufacturing. Finance existed to serve production. That relationship has now inverted. Today, production serves finance. And this inversion is not philosophical, it is measurable. Over the past half-century, the share of the U.S. economy devoted to financial activity has grown dramatically, while real wage growth has stagnated. Debt has replaced savings. Leverage has replaced margin. Liquidity has replaced resilience. This is not the result of bad intentions. It is the natural consequence of a system optimized for speed rather than durability. And systems optimized for speed always seek new anchors when instability increases. This is where the ultra-wealthy diverge from the public. Most people respond to instability emotionally. They look for excitement. They chase upside. They search for the next breakthrough that promises escape. Large capital responds structurally. It looks for insulation. This is why farmland matters now more than ever. For most of the 20th century, American agriculture benefited from abundance. Cheap energy, stable weather patterns, expanding arable land. Food was plentiful, predictable, and relatively inexpensive. That era is ending. Not catastrophically, gradually. Climate volatility is increasing yield uncertainty. Water tables are declining in critical regions. Input costs, fuel, fertilizer, labor, are rising structurally. At the same time, global demand for food continues to grow. This creates a paradox. Food becomes more essential and more fragile at the same time. Historically, whenever this combination appears, land values rise, not because of speculation, but because of necessity. During the 1970s inflationary period, U.S. farmland prices increased more than 300% in nominal terms. Not because investors were chasing returns, but because land represented something money could not guarantee: continuity. Billionaires understand that farmland is not an agricultural investment. It is a geopolitical one. It is protection against supply chain disruption, trade friction, and currency instability. And unlike financial assets, farmland cannot be printed. It must be acquired from someone who already owns it. Which brings us to a critical point most people overlook. Scarcity is not created equally. Some assets become scarce naturally. Others become scarce legally. Water rights fall into the second category. In the Western United States, water law is based not on ownership, but priority. The earliest claims take precedence. This legal structure was created during westward expansion when water access determined survival. What no one anticipated was how permanent these claims would become. Today, a water right established in the 1800s can outweigh the needs of millions. And as aquifers deplete and droughts intensify, these rights transform from legal technicalities into strategic assets. Cities have already begun paying extraordinary sums to secure water access. Agricultural regions are being forced to fallow land due to lack of rights, not lack of soil. This is not hypothetical. It is happening now. Historically, water scarcity has always preceded political and economic tension. From ancient Mesopotamia to modern California, control over water dictates stability. The difference today is subtle. The battle is not fought with armies, it is fought with contracts, and contracts favor those who understood the system early. This is why serious capital has spent decades accumulating water rights quietly, not to exploit scarcity, but to survive it. Now, consider how this fits into a broader pattern. When systems approach limits, wealth moves closer to fundamentals. Energy, food, water, shelter. These are not optional. They are civilizational constants. Financial assets fluctuate in value. Essentials fluctuate in power. This distinction matters, which brings us back to catastrophe bonds. At first glance, catastrophe bonds seem disconnected from this narrative. They deal with disasters, hurricanes, earthquakes, floods. But that is precisely their relevance. They are one of the few financial instruments tied directly to physical reality. Not market sentiment, not policy decisions, physical events. This makes them extraordinarily valuable in a world where financial correlations have increased dramatically. Over the past 2 decades, traditional diversification has failed repeatedly. Stocks and bonds fall together. Real estate follows. Liquidity evaporates. Catastrophe bonds remain largely unaffected. A hurricane in Florida does not correlate with interest rate hikes in Washington. An earthquake in California does not care about equity valuations. This independence is priceless. Historically, institutions that survived major transitions always held assets outside the dominant system. During currency collapses, those who held land endured. During political upheaval, those who controlled resources adapted. During financial resets, those with uncorrelated assets acquired. This is not about predicting disaster. It is about acknowledging complexity. Modern systems are tightly coupled. Small shocks propagate widely. Resilience now requires separation. And separation is expensive, which is why only large capital can afford it. Now let's confront a difficult truth. Most people cannot directly access these assets. They require scale, legal sophistication, and patience. This is not accidental. Systems do not distribute protection evenly. They reward early understanding and long-term thinking. But awareness still matters. Because even without direct ownership, understanding these shifts changes how one interprets the world. It reveals why certain policies emerge. why certain narratives dominate, why some risks are minimized publicly while being hedged privately. And this leads us to the psychological dimension. Late-stage systems depend on belief. Belief that growth will continue. Belief that interventions will work. Belief that past solutions apply indefinitely. Billionaires hedge not against collapse, but against disappointment. Against the moment when expectations adjust downward. That moment rarely looks dramatic. It looks like stagnation, like slow erosion, like the quiet realization that the future will not deliver what was promised. In such environments, assets tied to fundamentals outperform not because they grow faster, but because everything else grows weaker. Relative strength matters more than absolute returns. This is why smart money is not obsessed with upside. It is obsessed with survival. Now ask yourself a final question for this part. If you controlled more wealth than you could ever spend, would you chase excitement, or would you protect continuity? The answer explains everything. In the next part, we will examine what this means for individuals living inside this system. Not how to imitate billionaires, but how to think clearly in an environment designed to distract. Because understanding the structure does not require wealth. It requires attention. And attention today is the most mispriced asset of all. To understand what this shift truly means, we need to move away from assets for a moment and focus on behavior. Because wealth does not move randomly. It responds to incentives, memory, and risk perception. And the most important difference between the ultra-wealthy and everyone else is not intelligence. It is time horizon. Most people are forced to think in short intervals, monthly bills, annual income, election cycles, market quarters. Billionaires operate on generational timelines. They ask different questions, not what will outperform next year, but what will still matter if assumptions fail. This distinction has repeated itself throughout American history. During the early 20th century, as industrialization accelerated, public enthusiasm centered on stocks and speculation. Meanwhile, families that would later dominate American wealth quietly accumulated rail corridors, timberland, mineral rights, and oil leases. When markets collapsed, paper wealth evaporated. Control over resources remained. The same pattern appeared after World War II. While consumer culture expanded and financial products multiplied, institutional capital focused on infrastructure, energy, and land. Not because these were exciting, but because they anchored power. This is the lens through which current billionaire behavior must be understood. It is not reactionary. It is anticipatory. Now let's examine the psychological environment most people are navigating today. Modern financial culture is built on constant stimulation. Markets update in real time. News cycles refresh every hour. Social media amplifies urgency. This creates a false sense of motion. People feel active even when they are being guided. The system rewards participation, not reflection. And participation is most profitable when participants act emotionally. This is why narratives matter more than fundamentals in late-stage systems. Bitcoin is framed as rebellion. Stocks are framed as opportunity. Real estate is framed as security. Each narrative contains truth. But narratives are not strategies. They are emotional shortcuts. The ultra-wealthy do not operate on narratives. They operate on exposure. They ask, what happens if this fails? What remains if confidence erodes? What holds value without permission? This is why their capital migrates toward assets that do not depend on belief. Farmland produces regardless of sentiment. Water is consumed regardless of policy. Physical risk exists regardless of ideology. These assets are indifferent to opinion. That indifference is their power. Now consider the broader system Americans live inside. For decades, stability has been maintained through intervention. interest rates adjusted, markets supported, institutions rescued. Each intervention reinforced the belief that downturns are temporary and manageable. This belief shaped behavior. Risk tolerance increased, debt normalized, savings declined. Why save when money loses value? Why avoid leverage when leverage is rewarded? These questions were not foolish. They were logical responses to the environment. But environments change, and when they do, behaviors that were once rewarded become vulnerabilities. This is where most people will feel the shift first, not through collapse, but through pressure, rising costs, reduced mobility, diminished optionality. These are subtle forces. They don't feel like crisis. They feel like constraint. And constraint changes psychology. People become reactive. They chase certainty. They cling to narratives that promise relief. This is when misinformation flourishes. Not because people are ignorant, but because uncertainty is uncomfortable. The wealthy respond differently. They reduce exposure. They increase redundancy. They accept lower returns in exchange for higher durability. This is why farmland yields do not need to outperform stocks. They need to exist. This is why water rights do not need appreciation. They need enforceability. This is why catastrophe bonds do not need excitement. They need independence. Now let's address a critical misunderstanding. This analysis is not about copying billionaire portfolios. That is neither realistic nor necessary. Scale changes everything. What matters is understanding why these choices are being made. Because understanding changes behavior. It changes expectations. It changes how you interpret risk. For example, once you understand that systems protect themselves first, you stop assuming fairness. Once you understand that inflation redistributes quietly, you stop trusting nominal stability. Once you understand that essentials outperform narratives over time, you stop chasing novelty. This does not make you pessimistic. It makes you calibrated. History favors those who are calibrated. During every major transition, most people wait for confirmation. By the time confirmation arrives, adjustment is painful. Those who adapt earlier experience inconvenience. Those who adapt later experience loss. This pattern is universal. Now let's zoom out one final time. The world is not ending. The system is not collapsing tomorrow. What is happening is slower and more difficult. We are moving from an era of expansion to an era of constraint, from abundance to allocation, from growth-driven optimism to risk-managed realism. In such periods, the definition of wealth changes. Liquidity matters less than access. Returns matter less than durability. Speed matters less than positioning. This is uncomfortable for a culture trained to equate progress with acceleration. But history suggests it is unavoidable. The United States has navigated such transitions before. After the Great Depression, after World War II, after the inflationary 1970s, each time wealth restructured, each time narratives shifted, each time those who understood fundamentals adapted faster. The mistake is believing this time is different. It isn't. Technology changes. Human behavior doesn't. Fear and greed remain constant. So does the value of essentials. In the final part, we will bring this full circle. We will move from systems and history to individual clarity, not offering guarantees, not selling hope, but articulating a way of thinking that remains valuable regardless of outcome. Because in complex systems, clarity is the only real edge. At this point, it's important to slow down. Not to conclude quickly, not to rush toward solutions, but to sit with what has already become clear. Because this discussion was never about assets. It was about orientation, farmland, water rights, catastrophe bonds. These are not recommendations. They are signals. Signals of how those with the longest memory and the greatest exposure interpret the present moment. They tell us something fundamental. The system is not breaking, it is maturing. And mature systems do not reward speed. They reward positioning. For most of modern American life, progress felt linear. Work harder, earn more, invest broadly, trust institutions. That model worked, not perfectly, but sufficiently, because the underlying system expanded faster than its contradictions. Growth compensated for inefficiency. Debt was absorbed by productivity. Complexity remained manageable. That phase is ending, not because of incompetence, not because of conspiracy, but because all systems encounter limits. And limits change behavior. When expansion slows, competition intensifies. When resources tighten, access matters more than ownership. When confidence weakens, resilience replaces optimism. This is where many people misinterpret what they are feeling. They sense unease and assume something is wrong. In reality, something is changing. The emotional discomfort comes from misalignment, from using outdated mental models in a new environment. The ultra-wealthy feel this too. They simply respond earlier. Not because they know the future, but because they respect uncertainty. This is the single most underappreciated trait of durable wealth. Respect for uncertainty. It leads to humility. It leads to diversification beyond finance. It leads to an obsession with fundamentals, not returns. Continuity. Now consider what continuity actually means. It does not mean isolation. It does not mean hoarding. It does not mean fear. It means maintaining optionality when systems tighten, the ability to adapt when assumptions fail, the ability to remain solvent, financially and psychologically, when narratives break. This is why the assets we discussed matter symbolically. They are not dependent on permission. They do not require optimism. They do not collapse when belief fades. They simply exist. And existence in uncertain environments becomes the highest form of value. For individuals living inside this system, the takeaway is not to mimic billionaire behavior. That is neither practical nor wise. The takeaway is to adjust perception, to understand that not all risks are visible, not all stability is real, not all opportunity is growth. Sometimes opportunity is insulation. Sometimes progress is restraint. Sometimes intelligence is knowing what not to chase. This perspective changes how you consume information. You stop reacting to headlines. You stop mistaking volatility for danger. You stop assuming that loud narratives represent deep truth. Instead, you ask quieter questions. What remains valuable if conditions worsen? What holds value if policies reverse? What endures if expectations reset? These questions do not generate excitement. They generate clarity, and clarity compounds. Now let's address the final psychological shift. Most people are trained to think in terms of outcomes, predictions, forecasts, timelines. But complex systems defy prediction. They reward preparedness. History does not belong to those who guessed correctly. It belongs to those who were positioned flexibly. This is why understanding structure matters more than knowing dates. Structure reveals direction without requiring precision, and direction is enough. We are moving toward an era where essentials matter more than abstractions. Access matters more than ownership. Resilience matters more than optimization. This is not collapse language, it is transition language. Every major economic era has ended this way. Quietly at first, then unevenly, then obviously, in hindsight. The uncomfortable truth is that no one is coming to announce the shift. There will be no official moment, no clear signal, only accumulation patterns, behavioral changes. subtle reallocations by those with the most to lose. That is why observing what powerful capital does, rather than what it says, is so valuable. It bypasses ideology. It bypasses noise. It reveals incentives, and incentives never lie. If you've stayed with this analysis until now, that already places you outside the average. Most people prefer reassurance. You chose understanding. That choice matters more than any single investment. Because systems can absorb capital, they struggle to absorb discernment. If this perspective added clarity to how you see the world, even marginally, then it deserves continuation, not as agreement, but as conversation. A thoughtful subscription is not about support, it is about alignment. A quiet way of saying that depth still has a place in public discourse. A considered comment, one shaped by reflection rather than impulse, contributes something rare online. Signal. And if there is one person in your life who values careful thinking, nuanced discussion, and honest uncertainty, this is exactly the kind of material worth sharing with them. Not to convince, but to explore together. Because the future does not belong to those who predict it. It belongs to those who remain clear while it unfolds. Thank you for taking the time to think deeply. In an age that profits from distraction, that is already a form of wealth.